The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everybody. Welcome to your Inner Circle Live. Sorry for the slight delay in kickoff. I hope you're well. I hope you're what day is it now? Wednesday. Has been a good one so far. Delighted to welcome you guys both on GoToWebinar and on YouTube. It's a pleasure and privilege to have you here, whatever platform you're using to have a look at what we're doing here. So, thank you already for so many people putting messages in the questions box. Thank you very much. And some wonderful people here. Great to see you. Anyway, we're going to put up this important message just to remind you that this is for education purposes. I want to please make sure you do your own due diligence on anything you see here. Make sure you follow trading plans. Make sure you manage risk on every trading action, just with your own personal objectives and financial situation. Delayed to you guys who have just jumped from an EA starter course right to this session. I admire your willingness to listen to me bang on about some stuff. Thank you very much, Keith. Thanks for the heads up on the AV, Wayne. That's good. Roger, good to see you here. Hugh, always a pleasure to see you, mate. David, I hope you're well. I hope things are going good for you over there, and great to meet Dave and many of you, actually, or quite a few of you are here in Melbourne when I was over there a couple of weeks ago, even though you guys gave me a dreadful disease, which I'm now terming the Melbourne virus. Anyway, all's good, all's well. I'm on the mend. And as I said, delighted to see you here. Really impressed by how many turned up to the PCE live session that we ran, which was a GoToWebinar YouTube stream. G'day, Ron. Well done for jumping over, buddy. I think this will be useful for you. For those of you doing the EA courses, P6 is about to start. Of course, our first two models are going to be gap models based on what I'm going to talk about today. So very relevant to you guys who are part of that scene. Now, what we're going to do is we're going to do a quick whiz around the markets just to see where things are. And then, of course, we'll get into the educational component. So let's do that. Let's start with where things are at. There we go. It's me testing an EA where we've put in the data points. So it responds to data, but that's another story for another day. Here's where the major indices sit. Again, great to see some of you at the next bar session last night with myself and Cameron. Always good to catch up. Nice session that. You can see here the US futures are a reasonable, holding up reasonably well. Be interesting to see how that goes. We start with a little bit of a dip in the early part of the Asian session, but we're sort of moving upwards through the course of the European Open, etc. Watch this 64.56 level on the S&P 500 futures. Nasdaq did pull down a little more, but it's not pulled down about 3%. So that summer sell-off that everybody was predicting still isn't here. I'd be interested to see how markets respond tonight. Now, we have got some. Obviously, it's a shortened week, so we've got things jammed together. So, but it is US jobs week, as it always is at the first part of the week. So we have got some key data coming out. Whoops, let's just flip to there. If we look at what's coming out tonight, if we look at what's coming out this afternoon, you can see the PMI data that come out of Europe's a bit mixed. PPI was a little bit warmer than expected. So we have got the JOLTS, job openings and factory orders, coming out tonight out of the US. Neither of those are going to make a big deal, but you can see that strong number out of Australia on the GDP Q-on-Q number is interesting. Just quickly, I don't think the RBA rate tracker will be updated yet. You can see that there's a fairly strong chance there won't be yet another rate cut when they move next. That GDP is going to play into that narrative. But of course, the Fed, completely different ballgame. We are expecting for the next meetings in 2 weeks. We are expecting now an almost certain chance of a rate cut, 0.25% rate cut, when they meet in September. The key question in the US is, are we going to see another rate cut before the end of the year? Look at December. So the current rate is 4.25 to 4.50. So we've sort of priced in around about a 70% chance or 75% chance of at least one more cut before year end. That's what the market's pricing in now. So any movement away from that, any hot inflation numbers, any hot PCE, any more hot PCE, or any jobs numbers may alter that a little bit. What would help lock in that two more rate cuts after the September rate cut is what happens this week in relation to US jobs. Remember, last time we had non-farm payrolls out, it got belted. Not only in terms of what was expected versus what came out, but also the revisions to the downside. You can see there very, very little movement on that, only just in positive territory. So we are expecting that to play into that narrative. If it's any looser than that, it may well almost lock in 0.5% at least. So 2 rate cuts. If we look at tomorrow, we've got the ADP change, which is often a precursor. We are expecting a drop in that. Markets might respond to that. And also, of course, we've got the weekly jobs as well. So that's all very interesting in terms of how the market may position itself before that non-farm payrolls. You guys who are on the session, would you like me to run? Might have to deal with a different hat on, with the Trade IQ hat on rather than the Go hat on. But would you be interested if I ran a non-farm payroll session on Friday? I think it could be a really interesting market response to it. So that, I mean, I know it's pretty late for a lot of you on at the East Coast. It'd be about 10:30 p.m. your time. But there was, as I said, there was a spectacular number here. So if you'd like that, just type in yes in the questions box, or yes in YouTube. If you'd like me to do that, I can certainly stream it to YouTube as well. As I said, I think it should be a doozy in terms of market response to that. And so that's really what the market's waiting for right now. If we look at the futures in a bit more detail, you can see the Nasdaq futures looking the best of the indices. Looks as though that session is going to have to be locked in with the number of yeses I've got. Crude oil selling off again. We'll have a look at a chart of that in a moment. Gold is just going la to the upside. Bitcoin's had a little bit of a bounce, which is good. Thanks, Brett. And you can see there, US dollar just a bit weak today. Let's have a flick through some more charts. So that US dollar is sort of stuck in this range, really, as it has been since the beginning of August. But that hasn't deterred gold at all. So you can see there, smashed through 3,500 in yesterday's trading. It was just waiting. Lots of pending orders sitting above that previous resistance around about 34.30. You can see it tested 4 key times since the middle of March. Middle of April. And so when it went, it was like a coiled spring. It just went boom. I was surprised to see how positive that was yesterday, and how it continued. Today it's just a bit flattish. If we look at oil, you can see that's pulled off there, so stuck sort of mid-range again. Copper was interesting. Just keep an eye on Zip. Now, if you want an ASX stock, I'm really liking Zip. Just a little pullback now, opportunity if it breaches 432. Just keep that on your radar. As for copper, so copper has done. It looks as though it's breached as well a key level. So it was sort of, this is the tariff pre 50% tariffs in the US drop. Then we got a sort of flattening out through most of last week, and you can see this week it's been positive. We've got that breach of 454. I think this is probably heading up towards that. Not surprisingly, it's tested at 467. You can see how that's important. It's pretty well near the 200 MA. But I think this could work its way up around to around about this 480 level before it pauses significantly. But at this stage, very much on the up, pulling back some of that. We're only at about 15 to 20%, 15% retracement from that tariff drop. But because of the fundamental reason behind that, bear in mind that this was the after that tariff was announced. So lots of people buying before the tariff came into effect, and then the sell as soon as it was due. So copper's been interesting. Here's Bitcoin. Bitcoin is looking a bit precarious. So we breached this key level of 112,000, 112,500. Came down, tested 107. Nice, really nice bounce yesterday. A bit flatter today. I think this 112,500 is a key level to keep an eye on. It wouldn't surprise me to see a lot of assets in sideways trend before that data tomorrow. Looking at the FX market, I said the US was weak. It is against the yen. I wouldn't go anywhere near trading this unless we got a spike in the USD above 148. 87. But if we look at the euro, interesting price action on the euro, got stuck underneath 116.60. A breach above that could give us sort of 13 to 15 pips, but it's not filling me full of happy joy feelings. Euro yen seems stuck at around about this 173.21. Looks as though it's holding on to 173, which is interesting. So 1, 2, 3 attempts at that 173.21. So I'll keep an eye out on that later in the piece. And we'll just put one more up. And because of that strong GDP number, the Aussie yen is looking really technically interesting. It has breached 97, which was an interesting price level. You can see it was resistance, and really has been since mid-July. So the fact that it's breached another, to get this back, you can see even more so. The importance of this level of resistance there, support through most of there. So this looks like a high probability move on the Aussie yen. You've got a nice line in the sun, which was today's earlier high. So I'm looking at a 97.13 breach. Would be interesting. I think potentially, there's a potential 30 to 40 pips in the first instance, but I think it could go much higher than that. If we take it back to the daily chart, it's a big. The reason why this might go boom is because it's a multi-time frame trade. There's the next resistance on the daily chart. If we breach 97.45, which is around about 98.15. So this might be the sort of trade you could accumulate into. Really worth having a look at. That's my FX chart of the day. And I like the Nasdaq in terms of an index. I just would be watching this breach here of this 23,442 on the Nasdaq futures contract. I think that could rock and roll. Not sure where the pre-market's open here. Let's just have a look at NVIDIA pre-market. NVIDIA's dropped off. I think that this could be a buying opportunity in NVIDIA, but you'd wait until it was back over 174. And I like IEL on the ASX as well as ZIP. This is an earnings bump, but you can see there, which is sort of relevant for what we're going to talk about, big gap to fill. And it's taken its time to do that, but so it's getting there. This is the potential trade if we breach $6 is a nice round number. So there you go. There's a little market wrap for you. I hope that's giving you some things to think about. And so let's get into just checking on the questions. Yeah, I can, Stephen. Of course, I can look at. More than happy to look at GB pound Canadian dollar. I haven't looked at any Canadian dollar crosses today, but it's actually interesting. About 0.25% today, I think that. Okay, so on the daily chart, let's start with long-term context. We've had this pullback in the GB pound across the board, really. But this bounce looks interesting. It came down and tested this potential support level here. You can see the support there. It honored that. If we move on to the 4-hourly chart, really nice bounce on the 4-hourly chart. You probably so looking at support on the 4-hourly chart, you've got a 1, 2, 3, 4, 5, 6 wick revert, a 6-wick rejection of a move down through 184.40. Just going to put that there. So 184. So we're just beneath 185 at the moment. This level's at 185.15. The support represent about 40, almost a 50% retracement on this move to the downside. Potential upside. We go 185.70. If you take that into an hourly chart, you can see even more. This is even more compelling. So there's that line of draw at 185.14, which sort of locks in that move over 185. So the way I would probably play this is, I think a breach of that is an entry. I think this is a potential pause point here around about 185.42. So as soon as it gets near that, I'll be taking a stop from here and I'd be putting it sort of halfway up, locking in some of that profit. An interesting one. This looks like a high probability move. That sort of 30-ish pips first leg, if you like. So thanks for the suggestion. I'm delighted to have a look out for you, Steve. Right. Okay. Let's get into some educational chat stuff. I guess the first thing to say, or the first question to ask, is what is a gap? The reality is, it's one of those things where that lots of people talk about, but very few people actually have a successful strategy that trades it. And essentially, this is a price jump from a close to the next open. When comparing, or it doesn't have to be the next open, it can also be from two. If you like, the pure version is the close of one session and the start of another one. We see this almost daily on stocks. We see it over the weekend, or on because of what's happened over the weekend and pre-market auction. So we'll see it in FX and commodities over the weekend. We'll often see it in oil because we'll often see it in futures contracts on Mondays because of the commitment of traders data that's released on a Friday. If there's a strong move, if there's a strong change in institutional interest in any of the futures, and that can be index or commodity futures, then that may be reflected by it with a gap on Monday once we start to have a look at the commodity futures CFD contracts. And of course, we can see it after public holidays, after bank holidays, quite a lot. But also, of course, even though with Go Markets, MT5 platform, you don't see, we haven't got an instrument that just trades the FTSE during the FTSE hours. But there's nothing wrong with looking at the way a FTSE closed the previous day, aligning up your time frames. Sorry, aligning up your, just popping a little line on it, and then seeing how the FTSE open or how the futures respond to the next day. Now, that's often quite interesting. That gap between where the futures were and are is essentially priced in anyway. So if you get a continuation, so it's a slight twist on what we're talking about here. But in terms of one of the gap strategies they can use, it really can be quite valuable. Oh, you're in it short. It's interesting. Yeah, there's signs enough there that it might be done. But if you call that big move, good on you, mate. So the key to gap trading is to have there are various sorts of gaps. There's really two types of gaps that we're interested in trading with, and each of these merit a different strategy. So the key is, are you trading a strategy that is looking at a gap that is likely to be filled, or are you looking at a strategy which sees a gap and then there's a continuation in the same direction from that? And so there are three key questions. What actually is a gap, and how would you measure it? So what's a meaningful gap in terms of a minimum? And you've got to be careful of maximum gaps as well. What's the maximum? If you get a very, very big gap, it's less likely to be filled theoretically, because the compelling change in sentiment that's taken it significantly higher is unlikely to be filled in the here and now. So you've got to be quite explicit about how you define a gap. So if we were to look, let's pick the euro yen. And if we look, it wasn't a big gap in this weekend. So you can see virtually no gap there between close on Friday and open on Monday. Let's see if there was. Bitcoin's odd because it trades over the weekend. Again, see, market, because the way the market is flat at the minute, it's not actually very good. We wouldn't have seen many gaps at all on Monday. Okay. There's a gap there that looks like it could be a gap. Where's that? 4, 5, 1, 2, 3, 4, 5, 2, 3, 4. Oh. So again, virtually no gap at all on Monday. It's a tiny, teeny, tiny gap. So you'll see here, just move this up closer. So if we look at oil futures, there was a gap on Monday open, but it was very, very small. So that's why it's important. Would that be a gap you would look to trade? It's possibly a good example of a continuation. Okay, so there was possibly some COT data. I didn't see it that was bearish, suggesting institutional change. That created that gap. Yeah, that moved to the downside. Gaps in anything at all. What about the indices? See, even in the indices, there wasn't much gap in either. Little tiny gap again. Little tiny gaps aren't gaps, really. So that's what I'm saying. So you might say, right, okay, the minimum gap I'm going to trade is a 2 ATR or a 1 ATR on an hourly chart. If we look at a 15-minute chart, just out of interest, you would tend to trade the smaller time frames. Just take that out a bit. Okay, if we look a little closer, virtually no gap there at all. You can see very, very little gap. So we've got a small move there, but it didn't last very long. And it was another continuation. It wasn't a big bar and then a close of that gap to the downside. If we look at stocks, obviously there's gaps around here. So we've already got an example here of a gap. And that gap was very nicely filled. That gap was, in terms of close there, open here was about 3.79%. So closing that gap, tick off. That's really a gap that we're not that interested in. It was a one candle gap. Now, again, even with stocks, you've got a choice to make with stocks. Stocks are interesting. You can certainly trade. So again, this is a gap continuation. You see, there's a nice gap. That was nearly 10% gap. That would probably be almost your max. You see how that fluttered a little bit before it sprung into action. Absolutely got to watch the spread as well. I'll come on to that in a moment. So key thing is, what is actually a gap? How are we actually defining what a gap is? What's our minimum? What's our maximum? And what are we comparing this candle to in terms of the previous? And then, of course, you've got to make a decision about which gaps do you want to trade. Do you want to trade the post-weekend gaps? Do you want to trade the commodity gaps if there's a COT data that suggests that it might be good to trade? Do you want to trade if you like, a gap between where futures are? There's a very bit of slingshot effect often when you get a close. Let's say we use the DAX. If we get a futures price that's closed during market hours, futures in the overall index tend to ride together. After that, it's obviously dependent on what else is going on. But what you often get is, if the futures suggest a higher open, i.e. than the previous day, so there's your gap, then often you'll get almost a slingshot approach, because those, if you like, remember the amateurs open the market, the professional close it, so you might get an initial foray where you get lots of people piling in. So you might get a slingshot approach, but again, that's to do with managing that well. It's to do with what time frames you're trading. But that's critically, what gaps do you want to trade? Of course, then how do you do it? So let's look at the strategy one, gap fill. So really, ideally, as with a lot of trades, you're looking for a gap that's created, and then early signs across multiple short time frames that momentum's fading after the open bar. So you would look at what that opening bar is telling you. Let's say you were looking at a 30-minute bar. You would want to be seeing that perhaps the 5-minute bar, you've got a high of that, and then subsequently a drop off. So let's say, it's not a great example, but let's say that if we look at the start of today, what we got was certainly a higher price in terms of where the US closed here. The US market actually closed here. Okay, so there's two futures candles after the underlying equity market closes. So theoretically, we had a gap there, but if we look at the 30-minute chart, you can see straight away there's a fade to the downside. Okay, that doesn't look sustainable, and indeed that's what we saw. We didn't see the full gap close. 1, 2, so that's where the equity market closed. That was where we opened, which didn't breach yesterday's high, but even in that 30-minute to the left, you look at the 5-minute, you can see straight away we're seeing momentum to the downside that suggests we're going to get at least some closing of that gap. Now there's other things when you sort of explore this in this context, then you'll be looking at things like this level here, which proved to be an important point. So we'd look at previous key levels perhaps, and of course you would trail this down, and if you'd done that, if you'd sort of made, I mean, the momentum completely went out of this and moved to the downside, closed about 50%. But that would be about 49 points. So not a bad move to take advantage of on that open. And this is a good example of how we might trade an index, in that we would look at the close of the underlying equity market, look at how the futures, look at where the futures were opening, and then see if that's closed down. If there'd been some enthusiasm, as there was here, then we've got a potential move to the upside. So there's that gap created on Monday. That first candle looks great, with momentum to the upside, closing at the top of the candle, so we could potentially trade that and look for a pinch of around about 48 points. So now, obviously the approach for a fill is to move in the direction of the trade. So that first one I showed you in terms of what happened this morning was it attempted to fill the gap. Okay, the other one I'm going to talk about is if you like, the continuation. So you would usually set your initial profit target, if we look back at that Nasdaq potential trade. So you'd usually set a profit target here with an initial stop at this level here. So that's how you would set it up. Now, you maybe choose to trade the 5-minute bar. Okay, but what we're doing here is we've seen the gap on the 30-minute, we've seen the potential gap on the 30-minute, and what we're wanting to see is how it's looking on the shorter time frame. 30-minute, there it is. So we check the 15-minute and we see that indeed was weak on the 15-minute. On the 5-minute, so if we look at the 5-minute, that's confirmed on the 5-minute. So what we'll be doing is essentially so we'll put our stop. Let's put our stop there. Okay, which is around about that stage. That's around, so it'd be quite a tight stop. So that's probably about 280R from your entry price if you were using the end of the 15-minute candle. You'd probably get a little space. You would rarely enter on the 5-minute. You're really using the 5-minute just to say, yep, it's confirming that the momentum's gone in this pre-move here. There's not a continuation of that. You might use this as a yardstick in terms of, well, look, there's a short-term support on the 5-minute bar. That's possibly a little bit of overkill, but the concept is reasonable. So you might say, I'm going to spot it on if I see it on the 15-minute bar, I'm going to trade on the 15-minute bar. So you've also got the decision to make on which bar you're actually going to trade it. And it wouldn't usually be the first. So because Dave's point before, spread is obviously at its maximum. when markets open. And so you might have a minimum spread criteria within your trading plan or within your EA. So there you go. If we're looking at that idea, then the stops are placed above the initial gap price, and then trading stop to lock in profits. And you're often quite aggressive with that trail stop, particularly on a fill, because there may be if you can get an average 50% of a fill, then that's pretty good on most of your trades if that's your sort of target. So you can do things like partial stops, etc., of course. So what we might do at that 50% point, go back to this. So when it was going down, so that's our initial stop. Let's just move that line up there. That was our little reference line. So it might be that if we look at this gap here, so we say, right, okay, that is a gap from top to bottom is around about 100, just below 100 points. So what we might say is we might say at 50 points. So that would be at this level here. What we're going to do there is we're going to take profit. We're going to take half profit. This level here. Okay, so we're going to take half profit there, and we're going to trail the rest of our stop below break even. So now we're in a low. This would be a really good way to use this partial close thing. So you close half down here. If the rest runs, fantastic. If it doesn't, if it comes back as it did in this occasion, then you've made that money, and this portion that's left lost because you've trailed it above, or in this case below break even. Does that make sense? So it's not just about how you set up with the gap, it's a case of what you do next. Everybody knows it's relatively easy to enter a trade, but it's what happened next that really counts. Oops, no way. So the second strategy really is a continuation. So so in essence, you get a gap and then it continuing on from that, as we saw in that other potential NASDAQ example I gave, which is here. So this one was from Monday. There's the gap. Oh, it's about 27. Actually, that's the gap there. So that gap is about 1.5 ATR. Okay, so it's done that, but then the next candle after that gap is a biggie to the upside. Is this one. So again, if we look at our 30-minute, that says it's going. We might use our 50-minute or even a 5-minute on this. Let's use a 50-minute. We'll wait till the end of the 15-minute bar and then get in there. Then our stop, in this instance, becomes a move back into that gap space. It's more difficult to use a profit target on this one, unless there's a technical landmark back here somewhere. So we might do that. We might look at our 30-minute chart. That's the gap we're trading. Looks as though historically, if we look back, that could be the target on this. Reasonably, support, resistance, support. So that could be your maximum target. Just going to change that. Let's make that green. Okay, so this is the one we're trading. So with this, what actually happened was it was a total of 100. this actually got up to around about 66 points. We would probably enter at around about that 28 points line. So our potential profit on this is around about 71 points. So if we look at that, we'll do probably look at the same strategy about partial close. Halfway up, that'll be 35. So it'll be there, we'd partially close. So we'd trigger our partial close there for 50%. And then, of course, take this stop and move it up to break even, or just over break even, because then we get 2 winning trades. So we'd take this potential half off profit tick, this potential component left is a no lose. So that is how we would play that. Now this, as I said, I'm just using the NASDAQ now because it's handy. The same principle is with every other asset class. The key thing is once you pick the instrument, you need to define where the gap is. Okay. So with the NASDAQ, it might be that you choose that, the end of US equity versus the open of the following session, or you might say, right, the other gap I can do, the other gap I can potentially trade. So there's the end of the US equity session on that yellow line. The start of the following session is, let's just put an hour, it's easier to do on an hour chart. So as I'll close, our open on this will be 2, 3, 4, 5, 6. Will be there. So what we can do then, let me just get rid of all of these lines. Actually, what I'll do is I'll keep 2. Okay, I'm trying to develop a little tool that will actually, you can just plonk it on, say, start and your end time, and it'll give you the alternate, which will make life a bit easier in terms of doing this. But just one of those projects. Okay, so I think I knocked everything off. So our close from the previous day would be there. Okay, so that's our close. Our open for the next day on this would be, those two candles of 1, 2, 3, 4, 5, 6. That's the open there. So there's our gap. Okay, that's our gap there. So that's about 1.41%. That's interesting. So we look here, the gap has been created. This is our first candle. So the gap is actually created here. So it's between here and here. This is our first candle. Okay, so there's the gap. And actually, and so what we've got here is a close of that gap. So if we adopt the same principle, it's a little more difficult to see. Well, maybe put it on a line chart, maybe that'll make it a little clearer. So if we look at a close of this gap here, between the close of the US equity market the previous day and the open on this day, then that was closed by somewhere in the region of 283 points, 0.23%. So if you did it on the smaller time frame, okay, so I'll just put it back in the candles. So I might say here's our gap. It looked like a continuation here, so you could get trapped here. But in this case, if you're trapped on this, you'll be taking it out. You'll be putting your stop there, taking a small loss on that. Okay. If you're looking at, yeah, so continuation. you would be probably entering on this candle. There's the gap. Now there's the open. It's not really. Yeah, you'll probably enter that. Okay. You might be all right with this. Actually, it depends how tight your plan is and what time frame you're trading. Because you can potentially suggest the profit target is the previous day's low, which is there, which it actually touched. So this is the gap. It's a continuation. If you go on the back end of that, there's potentially 73 points. You could do 35 with a potential partial close. I'm not sure the Nasdaq is the best one to trade, but you like this. But that's the principle. So it'd be exactly the same with the FTSE. You'd find the FTSE close wherever that is. So it might be here-ish. So it's about 12 o'clock. So what's that? 1, 2, 3, 4. There is the FTSE close about there. So there's the FTSE close on that line. And then the FTSE open. We're obviously open now. Is around about there. So the gap between close and open is there. Now, as I said, if you're doing this, you're looking really for a slingshot. And we look as though we're getting that. So you would look at this first candle here. You'd say tick that off. Maybe move to a 15-minute chart. So even though you're trading the futures contract, you're still trading this gap. Now, in terms of a profit target on this, again, that would be sort of where I would be popping it based on that previous price action. So in this case, around about 45 to 50 pips if this was the FTSE, if this was the FTSE. Because we've got a gap, and then we've got a continuation. So just to reiterate that, so I'm looking for a move in the gap direction after the first bar with a high volume confirmation. And what that's saying is that buying pressure is continuing that direction. I've stressed the high volume confirmation there because it is important that you don't just look at the gap. You need to look at things around that, which may create a high probability move. You can also accumulate, of course. You wouldn't really accumulate unless the gap was really big, with a fill in the gap on CFDs, sorry, on FX and indices. You might with shares. You might accumulate if it's a big enough gap. So for the IEL that I sort of referenced earlier, where are you going? Okay, so there's the gap. Earnings gaps are okay provided you get follow through. But I would say earning gaps are slightly do have a tendency to fill sometimes. So we might get a fill here. So the jury's out on IEL. So we could have potentially said, right, there's the gap there between that key level and that key level. The actual gap is there, but it would be looking at there in terms of coming back the other way. So this is sort of interesting. So you got a gap. It looks as though it wants to potentially fill. So you could have got on. You could have gone on this day. And then you're sort of tinkering with stops and stuff in there, but you're wanting it to go down back down towards 490, which would be a very healthy for a stock. That would be a very healthy move. So let's say you got in here. That would be a 14% move to the downside to fill that gap. Does that make sense? Just going to check in on YouTube to see if there's any questions or comments there. Feel free to put anything here. Hi, Sonia. Hi, Wayne. Yeah, lots of yes pleases in there. That's great. You guys in YouTube, don't forget to, if you are doing that, if you are there, it'd be great if you could just smash a like on the video. That'd be awesome. If you wouldn't mind. I think most of you are just watching this on GoToWebinar as well. Okay, so that concept of retesting that potential gap is quite common, as we saw in that on that IEL trade. So it created the gap. It looked as though it was going to fade. Just move back up to the top of that. Gently, that's not uncommon. That's why you place your stop outside of that gap range. So with the continuation, you're aiming to gather a momentum trade. So once all these people see, oh, that gap's that gap's not going to be filled, everybody gets very excited about the fact that it's continuation. Just watch things like proximity to the next key level and all that sort of stuff. That's really probably key to both of these. With the gap fill, it's probably quite easy because your target is probably, well, your target undoubtedly is the gap. You probably put a little spacer in between the profit target and where the gap will be fully closed, maybe half an ATR or something of that ilk. But you would still potentially look back and see if there's any key levels of interest. So, fractals or swing highs, swing lows. And as I said, one of the things we're looking at is possibly the COT data, the traders data. And whether we see a movement all happens probably 6 or 7 times a year that we see that. Confluence factors. So things to have a look at, as I already said, key levels. So look at prior days or prior sessions, high or lows. With stocks, certainly pivots might be useful. In fact, with all in, if you've got a pivot, which you can get from me, if you want a pivot indicator which puts things on, then I'm going on here. So there you go. So pivots are always a good idea to have a look at. Market looks at these, so that's a daily pivot. You can see there's lots of price action around there. Once it breached through there, it sort of made its way up very nicely. If we look at today's price action, resistance at the R1 pivot, so there's a good place to potentially set profit targets. If you've got a gap and it was sort of here and there's a pivot above it, it might be reason enough not to get in. If there is a pivot there and you're already in, it might be a place to put a stop. Volume after the opening bar, particularly in the continuation. If you're looking at volume on the gap fill, you're probably looking at a shorter time frame again. So you may be looking. So let's say you're looking at a move through a 15-minute bar. Sorry, trading a gap on a 15-minute. It might be the 5-minute volume you're looking at for increasing. Candle structure, still the rules apply. You want a bearish candle, you want it closing in the bottom half if you're going short, and top half if you're going long. Just keep an eye on economic data. You can't ignore that. And as David's already referenced very early on, just watch the spreads at and immediately after open. If you're using this to create an EA, you'd probably have some code that looked at the current spread and said it's got to be less than whatever it is. And then, of course, we're looking at relevant timeframes. Again, the you guys doing P6 and having the gap stuff, you're going to have the option to optimize to find out which is the best for each instrument and each strategy. So this is what it might look like. So if you're drafting a strategy, make sure you list the instrument, define the session anchors you're going to use. So flash close of the underlying market, settlement. So you might use the end of the NASDAQ trading day rather than the US equity close, for example. So the NASDAQ futures. With Friday and Monday, you're looking at the close of the market plus the open of the next one. Make sure you've got your timings right, all that sort of stuff. So as I said, you need sort of thresholds. So you might sort of say, right, I want a minimum of. I think that's a bit low. I think you've got a bit enthused by that. I think that might be the. So you might say, I want a minimum of 1.2. Depends what. Depends how aggressive you're going to be, but you might want a minimum of 1 to 1.5 minimum to say there's a gap in existence. With your continuation, invariably over, it will be a slightly over ATR. So fill and go playbooks with entry triggers. So what are you going to use? Are you going to have an accumulation strategy with your... Actually, that's an increase in ATR. Are you going to have an accumulation strategy with your flow or continuation strategy? Candle structure and volume I've mentioned. Proximity of key levels I've mentioned if they interfere with upside potential. You want the move of the next candles or the move within smaller time frame candles to confirm it's going in the right direction. You might look for a higher time frame trend as well as a confluence, and then use the gap levels to assist in stop placement. So you might say, right, okay, I'm going to do half an ATR below the gap. If I'm going long, you would set a target, and with a trail and possibly a partial stop. And then, of course, if there's any potential data interference, which is a new term I'm going to use again and again and again for those of you who hear me, then if there's data interference, i.e. some economic data that might be coming out that might either directly or indirectly influence in it, then of course you would be cognizant of that as well. So that's what your strategy should look like, essentially. So if you want to screenshot that very quickly, that should help. But the key things are, or the key start points are defining what market you're going to trade, what time that relates to. So your anchors, these session anchors, if you like, and what comprises a gap. The rest is fairly easy. But as I said, your primary exit, so your initial stop and your potential partial close related to your take profit, which of course we're looking to not only automate within our, which we do automate already within our EAs, but of course we're looking for that exit only automation that we talked about a couple of sessions ago, actually. So that's it. So have you any, that's what I was planning to cover tonight, just sort of fill you in on how it all works. There we go. That's what I was looking for. So, I mean, I guess in terms of this review, the content that we've covered today, is this strategy worth integrating into your trading? It's one of those strategies where you have to be absolutely rigid. I would suggest you always have to be absolutely rigid, but even more so with this, there's not much room for error, particularly on exit. But whether you're an automated trader or whether you're a discretionary trader, there's potential there. Once you've got that strategy nailed in, and of course, if this is of interest to you, then create the plan for action. If there's anything that you want to follow up on, any follow-up questions about this, about how you may automate it, how that might differ, or any of that sort of stuff, then of course pop me an email at any time. Now I'm going to try and make this going forward within a circle. We persuade them that we need to go to webinar back, so people have a choice. They could either go to webinar or do it streaming on YouTube. So either way, it's good. I trust that meets with your approval. Most importantly, thank you for rocking up tonight. It's been a pleasure and privilege. Thank you very much for your participation in terms of questions you asked and the support you've given. Do you want to quickly look at those charts again before we disappear? Keeping an eye on. We're having a look at the Aussie yen. That does look as though it's going to go up and test that 97.13 level, doesn't it? It's looking like the one hop to trot. Cheers, Hugh. Always good to see you, mate. And let's pop in. We've been having a look at the Nasdaq all the time. Let's just pop in and have a quick look at gold as well. See if we're still. Oh, we'll get the buyers back in. This is difficult because on the shorter time frame, you've now got a multi-wick rejection around about 35.41, which has been tested here and tested here. 30-minute chart, it's got to close above that. Hourly chart, got to close. We've got multi-time frame agreement on this. This is really interesting. If it breaches that line, multi-time frame, we're going to get it go boom. It's going to be up at 3,600 on this particular futures CFD. Good stuff. And let's think about GB pound Canadian dollar, see what it's doing as well. Yeah, it just looks as though it's fading now. So it's done its move. And that 185.15 would be the level I would just keep an eye on. It's already come down and tested 185 and edged its way through that. Although that doesn't look like a convincing sell. Yeah. Anyway, guys, take care. Trade safe. We'll catch you again very soon. Thanks, Keith. Thanks, Wayne. Thanks, David. Cheers, guys. Take care. Bye-bye for now.